Well, let's talk about what's really going on here right now. This is historic. Never before has all three indexes run in backwardation. Let's explain what's happening. So yesterday we dove into a critical shift happening in the silver market called backwardation. As we saw, this was when the spot price of silver rises above the futures price, indicating that the physical demand is starting to overwhelm the paper markets. But today, let's take a step further and talk about the broader dynamics between contango and backwardation and what these shifts mean for silver's future. To begin, let's quickly review the typical market structure. Under normal circumstances, the silver market operates in contango. That means that future silver prices are generally higher than the spot price. Well, why? Because the futures price includes factors like storage cost, insurance, and the time value of money. Contango reflects the healthy market where a future delivery is considered more expensive, reflecting the cost and risks of holding metal until that future date. But every so often, something unusual happens: backwardation. This occurs when the spot price exceeds the futures price, meaning the buyers are willing to pay more for immediate delivery than for future delivery. What do you think is causing this? Are they not trusting the other bankers that they actually don't have the gold that they own? Well, we know they don't because the paper shorts are 374.58 paper ounces of silver for every 1 ounce of physical silver that exists. That's what's causing scare here right now. So this is a sign of extreme urgency in the market. And right now, as we discussed yesterday, silver is experiencing this rather rare event across all major exchanges. This is the big one: New York's COMEX, London's LBMA, and Shanghai Gold Exchange. What it does, it tells us the market is saying we need silver now, and we don't trust that it will be there later. This backwardation is not just a statistical blip; it's a reflection of deep structural problems within the silver market. For years, we've seen silver run a structural deficit, meaning that the amount of silver that we're consuming is greater than the amount of silver that's coming out of the ground. So currently, we're consuming about 1.2 billion ounces of silver. We're only bringing in less than 900 million. So that difference there is what's called a structural deficit. It's coming out of the sources that we already had above ground. So demand has consistently outpaced supply, but the problem has become acute. Physical silver is now so scarce, and Uncle Ted tell you, that buyers are willing to pay a premium for immediate delivery, something that doesn't usually happen in a healthy, functioning market. Now, let's explore the effects of contango and backwardation in greater detail and why the shift is so significant. In contango, the futures price being higher than the spot price typically indicates a stable or growing market. Producers, traders, and investors are comfortable with the future price being more expensive because they believe the metal will be available when needed. It's a situation when the market believes things are under control, but are they? Futures traders are comfortable buying and holding metal for a future price that reflects the cost of carrying that metal forward. Should you be playing the same game? However, in backwardation, things go the other way. The immediate demand for silver is so intense, which it is, that traders are willing to pay a premium, which they are, for silver today, rather than waiting weeks or months for a future contract. This is the real signal that the market is under stress. It tells us that buyers are worried about the availability of silver in the future and doing whatever it takes to secure it now. We know what's happening, don't we? The market behavior is a stark departure from the typical normal market operation of contango. The effects of backwardation go beyond just higher spot prices. When the spot price exceeds the futures price, it creates a situation where the market is signaling a shortage of deliverable metal. It means that those with physical silver are holding on to it more tightly, aren't we? Not willing to sell at prices that might seem low relative to pressure mounting on silver chains. If you're in the inner circle, I've been advising you all, do not sell. We'll put out a time that you can start letting some of the horses out of the corral, but please don't sell the silver until we say it now might be the time to let some horses out. Yet the supply side of the equation is constrained by one simple fact: silver is rarely mined on its own. It's primarily a byproduct of other mining processes like copper, lead, and zinc. This means when the silver price of silver rises, miners can't simply turn up the production. They're still limited by the demand for the other base metals. We've also seen other pressures on the silver market: geopolitical risks, logistical bottlenecks, and rising production costs are all exacerbating the problem. These combined forces are contributing to dramatic backwardation we're seeing right now, especially in industries, users scrambling for available silver to meet their needs. So with those of you that hold dory bars and rounds and that kind of stuff, that's your customer. Not everyone else is going to be needing silver as money. The fungibility of this type of silver, bars and rounds and meanie babies, is nowhere near the fungibility of dimes, and dimes are less expensive. $1 over spot. So what does this mean for us as investors, enthusiasts in the silver space? For one, it's clear that the balance is shifting. For years, the silver's price was controlled largely by the paper markets, the futures contracts, derivatives, and short positions that kept prices artificially suppressed. They used digits on a computer screen. That's all they did. So, but now, for the first time in years, we're seeing physical silver take charge. Absolutely. You can fool all the people some of the time, some of the people all the time, but never all the people all the time. And we're at that point right now. The demand for physical metal is real and is pushing prices upward in a way we haven't seen in a long time. Is this the end of the paper market's dominance over silver? So whether you've been holding silver for years or you're just now getting into the market, this shift in market dynamics should have your attention. It does mine. The signals are clear, crystal clear. The market is under stress and physical demand is king, and the waves are going out. We're going to find out the emperor has no clothes. And for those of us who have been advocating for silver so long, watching the shift is like a long-awaited validation, isn't it? The paper market, for better or for worse, is no longer the only player in town. Thank you for tuning in. And as always, if you want to keep up with the stories no one else is telling, don't forget to like, subscribe, and share this video with a friend. We'll see you next time, but we have a whole lot more unpacking to do.
Hi there, this is Sharon Duffing at the Minnesota State Capitol. It is Friday, April 4th, 2025, and I'm here to double check on what everybody's been talking about on social media, is this plaque in honor of our governor, Tim Walz, and it is from people that are supportive of his efforts, and there it is, right here in the East Hall. Lower level. It reads the Democratic Coalition of Satan Worshippers thanks Governor Tim Walz for not standing in the way of spreading Satanism in the state capitol building. Satan has a special place for you. And that's what it says.
If a businessman makes a mistake, he suffers the consequences. If a bureau makes a mistake, you suffer the consequences. Ayn Rand, she wrote the book Atlas Shrugged. You might want to take a look at that. It's a long book, but there's a movie out that explains what's going on.
Harvard is not a university. It's a business. Harvard University is run by a 12-person board that's known as through the Harvard Corporation. The Harvard Corporation is what runs Harvard University. And the head of the Harvard Corporation is Penny Pritzker. Penny Pritzker was previously the chair of the Carnegie Endowment for International Peace. If that sounds familiar, it's because that's the organization that was run for 7 years by Bill Burns, the man elected by Joe Biden to be the head of the Central Intelligence Agency. Harvard is essentially a foreign policy tool in order that merges financial markets with intelligence and statecraft to impact global policy, foreign policy, and the domestic drivers of foreign policy, which include running out a president who might oppose a foreign policy that interferes with Harvard's bottom line. Harvard invests deeply and has since the Cold War ended. Harvard has been deeply invested through the Harvard Endowment in seizing Eurasia from Russia, which puts Harvard directly at the center of Russiagate. In the 1990s, everyone can look up a great article called "The Harvard Boys Do Russia," or any deep dive you want to go down on a little place called the Harvard Institute for International Development and its role in privatizing and stealing the wealth of Central and Eastern European countries, and particularly Russia, during the 1990s, when, if that name sounds familiar, the Harvard Institute for International Development may sound a little bit like the United States Agency for International Development, USAID. Harvard had its own USAID cell that got $500 million from USAID to be the long arm of USAID to loot the economic wealth of Russia in the 1990s in tandem with George Soros. Harvard was doing the dirty work of the U.S. government by putting its economists over there, by putting its liaisons over there, by building up a giant network over there, midwifing that process. And in return, the Harvard Endowment got non-competitive bids and private access at fire sale prices to the publicly held wealth of foreign countries. They did the same thing in Ukraine. They did the same thing all over Central and Eastern Europe.
If wars can be started by lies, peace can be started by truth. How true, Julian Assange. Scott Jenkins, his wife Patricia, and their family have been dragged through hell of corrupt and weaponized Biden DOJ. In fact, during his trial, when Sheriff Jenkins tried to offer exculpatory evidence to support himself, the exculpatory evidence, folks, is evidence that proves his innocence. Okay, that's what exculpatory means. The Biden judge, Robert Ballou, refused to allow it. Can you imagine this? Refusing to allow evidence that proves he's innocent. To shut him down and then went on tirade. As we have seen in federal, city, and state courts, radical left or liberal judges allow in the evidence what they feel like, not what is mandated under Constitution and rules of evidence. This sheriff is a victim of overzealous Biden Department of Justice and doesn't deserve to spend a single day in jail. He is a wonderful person who was persecuted by the radical left monsters and left for dead. This is why, as I, President of the United States, see fit to end this unfair sentence and grant Sheriff Jenkins a full and unconditional pardon. He will not be going to jail tomorrow, but instead have a wonderful and productive life.
Here we go.
All right, folks, what I'd like to do now is show you the U.S. debt clock because he mentioned something as far as the defense of our country. This is how much we're paying right now to defend our country. However, this is the interest that we're paying on the debt. Now, there's something called the Ferguson Law. The Ferguson Law says when the interest on debt exceeds the defense budget, then the country's on the downhill. So clearly we're in that category right now. Couple other things to share with you right now. Naked paper shorts are up to 374.58, which means they sold each ounce of silver 374.58 times. Are you sure you want to hold your wealth digitally, or should you hold it yourself in your own purview? Now, the other thing I want to share with you right now is the Bank for International Settlements. That's a clip that's coming up right next. A lot of you have never heard of the BIS, and I want you to understand that the BIS is the largest corporation on the face of the planet ever been. And the reason why is because they own all the banks in all the countries. Let me show you. No sleight of hand here, okay? This is what's called the BIS, the Bank for International Settlements. Big heavyset guy here, right? So we're going to go up here on this gray search bar line. We're going to touch that, okay? Then we're going to come down to Central Bank and Monetary Authority websites. We're going to touch that. And then you pick a letter A through Z. They own all the banks in every country. I'm not talking about the United States, they own Bank of America or whatever. No, they own all the banks in the United States of America under the Federal Reserve Bank. They're not federal, they have no reserves. So watch this. So you go here to, let's just pick, oh, my goodness. Oman, every country on the face of the planet, with very few exceptions, is represented here. Look at this. These are all the countries that they own the banks in. But look how they own the banks. Bank of, Central Bank. But look what they did to the United States of America. They called us the Federal Reserve Bank. It's not federal. We have no reserves. But look at this. They own it all. And you know what? Let's just pick one here and say, oh, Ted, I don't really believe you. Okay, well, let's pick Romania here. Let's see if it populates. You daggone right it populates. This is all real. This one company owns all the currencies on the face of the planet, and they've been doing it for a long time. Fed quietly buys $43 billion, $600 million in treasuries in alleged stealth QE operation after China abruptly dumped billions in bonds. Well, it's created that out of thin air. So what do you think it's worth? Let's go back to see what Voltaire had to say. Intrinsic fiat currencies always return back to their intrinsic value. Voltaire, Voltaire. The Federal Reserve just bought $43.6 billion in U.S. Treasuries in the span of a week, sparking concerns that a quiet quantitative easing operation is underway. Not so quiet, we know about it. New documents show the Fed purchased $8.8 billion in 30-year bonds on May 8th via its system open market account, a move that followed a $34.8 billion purchase earlier the same week. Just dollars flying out of nowhere, increasing the money supply. Folks, this is what's called inflation. The move has triggered allegations that stealth QE has arrived, with a Market Watch op-ed by Charlie Garcia calling the move monetary policy on tiptoes. The Fed has long stated such purchases are routine reinvestments of maturing securities to adjust the money supply and influence interest rates to meet its targets. My question to you is the amount of silver being increased the way they're increasing the digits? And the answer is no, because gold and silver are God's money. It's on the periodic table. The Fed's buying spree follows a major Treasury sell-off from China. The new numbers from the Treasury Department show China sold Sandman $18.9 billion in U.S. bonds in March, while most other countries increased their holdings. China now holds $765.4 billion in treasuries and is the third place behind the UK and Japan, which holds $779 billion and $1.13 trillion. Look at that. Japan, much smaller than China and the UK, holds way more debt than either of those two countries. Is that a good thing to do?